Now let's go on to the next topic, which is analyzing and recording transactions. Up until this point, what we've been talking about is what is accounting. And we said that accounting is a system that records, classifies, summarizes, and reports financial information to stakeholders for good decision making. And what we meant by that is that this is a system that provides information to interested people looking at a company so they can make a decision of whether they want to do business with that particular company. So accounting becomes really important. Now, in order to understand the significance of accounting, one of the things that we need to take a look at is what we call the accounting cycle. Now, we talked about this accounting cycle in the last chapter, but I wanted to kind of go over it again just to kind of reinforce the importance of understanding the process that we go through as we record accounting transactions into our accounting system. We start at the top of the screen with a transaction. Now, this transaction has to have a financial impact on our accounting equation of assets equal liabilities plus stockholders' equity. We need to analyze that transaction to determine what's that impact so that we can record that in our journal. Now, remember the journal, and the normal one is called the general journal, is a document that we enter our information into, and we place that information in chronological order. Now, by putting it in date order, what we basically have is a running list of every transaction that is affecting our company on a day-to-day basis. Now, with that, we know that there's going to have to be at least 2 entries at a minimum that go into the journal for every transaction. Because if you remember in the last chapter where we worked on that accounting worksheet where we showed the assets, liabilities, and stockholders' equities and the various components that made up those 3 categories, how the transaction affected our accounting equation. Once we enter into the journal, then we take the individual transactions and we post them into the ledger into account order. Basically, each account or category for each transaction so that we can then summarize that information for the creation of our financial statements. The rest of this accounting cycle that we're going to be talking to in the next 2 chapters, all the way through the financial statements and the closing of the books, completes the accounting cycle so that we can continuously be keeping track of our company. So once again, we have to look at a transaction and we have to analyze that transaction. We have to ask the question, how does that transaction affect our accounting equation? Does it increase or decrease the asset, liability, or stockholders' equity account? When we record that transaction into the journal as a journal entry into the journal, we put that in so that it represents exactly what happened, with explanations and what's our reasoning behind that posting. Then we post the entry into the ledger so that we can summarize it. So let's take a look at how we do that. As we were saying, when we analyze financial transactions to determine how we're going to record this into our general journal, what we have to do is take a look at the transaction and ask the question, how is my accounting equation being affected? So if I have my accounting equation of assets equal liabilities plus stockholders' equity, and of course stockholders' equity is broken down into dividends, revenues, expenses, where these 3 items represent the detail of the retained earnings account, we can take a look at the transaction and ask the question, does that increase or decrease the accounting equation? Now, the increase or decrease of the accounting equation as it's being recorded into the journal entry is represented in many times by this T, which we call a T account. Now, this T account has 2 sides to it, the left side and the right side. The left side is called a debit. The right side is called a credit. Now, notice that regardless of whether it's an asset, liability, or equity, the left side is always the debit side. The right side is always the credit side. Debit and credit do not describe an increase or a decrease until you understand which account that transaction falls under. Is it a liability, asset, liability, or a stockholder's equity? Now, if it's an asset, debits increase asset accounts. Credits decrease asset accounts. Now, because of this equal sign, everything flips the other way. So a liability increases with a credit and decreases with a debit. Same thing over here with stockholders' equity. Stockholders' equity increases with credits and decreases with a debit. If we look at the detail of stockholders' equity as the dividends, revenues, and expenses, let's first look at revenues. When revenues goes up, revenues will increase stockholders' equity. So because stockholders' equity is increased with a credit, revenues increase with credits. If we were to make some sort of an entry on the credit side, or the debit side, which there's a typo here, on the debit side of the revenue account, that would decrease revenues. And a decrease in revenues would decrease stockholders' equity. Now let's look at an expense though. An expense is something that we've paid out. So if expenses go up, ultimately what happens is stockholders' equity is going to go down. So therefore, when we look at the T account for expenses, if we have an increase to an expense, the stockholders' equity is going to decrease. So therefore, we're going to when we increase an expense, we're decreasing stockholders' equity. So increases to expenses are debits. Decreases to expenses are credits. Take a look at dividends. Dividends, very similarly, if we pay out a dividend, which is a return on investment to our stockholders, when we pay our stockholders a dividend, we take it out of stockholders' equity. So therefore, if a dividend goes up, it's going to decrease stockholders' equity. Decreases to stockholders' equities are debits. So an increase to a dividend, which will decrease stockholders' equity, is a debit entry. And a decrease would be over here on the credit side. So let's go take a look at some problems in this chapter. So let's look at exercise 2-2. In exercise 2-2, what we're asked to do is analyze the various accounting entries and balances that affect an account in our accounting equation. Now, in A, B, and C, which are separate situations, what we have is basically I've created a T account here so that we can take a look at each transaction. In A here, it says, during October, Alameda Company had $102,500 of cash receipts and $103,150 of cash disbursements. On October 31st, the cash balance was $18,600. How much cash did the company have at the close of the period? Now, what we could do is take a look at this T account. Now, knowing that cash right here is an asset account, we know that a positive balance in cash or an increase to cash will be on the debit side of the T account. A decrease in cash will be on the credit side of the T account. So what I could do is I could say, take my beginning balance on this side. I know that this will be my cash increases or cash receipts. And I know on this side are going to be my cash decreases. And then if I take a total here, my ending balance will be over here on the debit side. So what we can do then is we could actually ask this question, take a look at this problem, and I'm going to erase out my descriptions here, and we can fill in the blanks. So here we said, well, how much is our beginning balance? Or we need to figure out what our beginning balance is. So that's our question mark here. So let's put a question mark here as what's our beginning balance? Now we look at here and it says that our cash receipts, which are our increases, were $102,500. And our cash decreases were $103,150. And that we know that our ending balance is $18,600. So in other words, we know that our beginning balance plus our increases minus our decreases will give us our ending balance of $18,600. So I could actually create a little formula, an algebraic formula here that basically says my beginning balance X plus my cash increases of $102,500 minus my decreases of $103,150 will equal $18,600. So if I solve for that, my X is going to equal $19,250. So this value here ends up being the amount of what the beginning cash balance was. So we can do the same thing with accounts receivable here for problem B. In problem B, once again, let's try that again. Our beginning balance, because this is an asset account, is going to be on the debit side. Now, our accounts receivable are going to go up. So my accounts receivable increases. My accounts receivable decreases. And my ending balance. Now, the question is what increases accounts receivable? Accounts receivable are the balances from our customers that owe us money. So in other words, if we sell to our customers on credit, we will be increasing our accounts receivable. When our customers pay us and they no longer owe us the money, we're going to have to decrease the accounts receivable. All right, so let's do this. Let's clear out my descriptions again. So now we'll look at the problem, and it says on September 30th, Valerian Company had a balance of $102,500 in accounts receivable. During the month of October, the company collects $102,890 from its credit customers, and the October 31 balance accounts receivable was $89,000. So what we have here is, if you look here, September 30th, we're doing this for October. Accounts receivable is one of these types of accounts on the balance sheet that is not going to zero out at the end of the month. The ending balance in one month is going to be the beginning balance in the next month. So therefore, the ending balance on September 30th is our beginning balance for October 1st. So what we're going to do then is we're going to put in here $102,500 as the beginning balance on October 1st for the company. Then it said, and we said here, during October the company collects $102,890. Well, collection is when we receive cash from our customers. And if the customer pays us, they no longer owe us. So therefore, we need to decrease accounts receivable. So we're going to go ahead and put the $102,890 on the credit side of accounts receivable. Finally, in the problem, it says on October 31st, the account balance and accounts receivable was $89,000. In other words, what they're telling us is the ending balance was $89,000. So what we need to figure out, and what they want us to figure out, is how much did they sell on credit? So that's our question mark. So once again, we can now create a formula. We can say our beginning balance, which is 102,500, plus our unknown, which is what we sold, minus what we collected, will equal our ending balance. If we do the math, the sales that we make will be $89,390. Now for the last situation. The last situation says Quarantine Company had $152,000 of accounts payable on September 30th and $132,500 on October 31st. Total purchases on account during October were $281,000. So how much cash was paid on accounts payable during October? Once again, this is for October. Now here's where something's different. Accounts payable is a liability. And since it's a liability, the increases and decreases switch sides. Remember, an increase or a positive balance in accounts payable is going to be on the credit side or the right side of the T account, and a decrease to accounts payable will be on the debit side of the T account. So what we're going to have here is that if accounts payable, a liability, has a positive balance, the beginning balance is going to be on the credit side of the entry. Now, what is accounts payable? Accounts payable is when your company owes money to a vendor. In other words, you purchase something on credit. So therefore, if you buy stuff or an increase to accounts payable will be on the credit side. If you pay for those liabilities or you pay your bills, you're going to do a debit entry to recognize the decrease in your obligation to pay your vendors. And then your ending balance will end up being on the credit side. So once again, let's go clear out our descriptors. So let's read the problem again. It says Quarantine Company has $152,000 of accounts payable on September 30th. September 30th is the last day of the prior month, so therefore this 152 is the beginning balance of accounts payable for October 1st. So we're going to put this on here on the credit side as $152,000. Then it says that $132,500 on October 31st, which is our ending balance. So we want to put the $132,500 here. So then we have to ask the question, what are my increases and what are my decreases? It says here that total purchases on account were $281,000. So in other words, we bought stuff on credit in October, so we're going to increase the accounts payable account by $281,000. So then the question they want us to answer is, how much should we pay accounts payable during the month of October? In other words, what are the decreases? So I can go ahead and create my little algebraic formula again. If we say my beginning balance of $152,000 plus my increases or my credit purchase minus the payments that I made will equal my ending balance of $132,500. Solving for x, we will come up with $300,500. So these three accounts that we're looking at here are balance sheet accounts. Cash and accounts receivable are assets. Accounts payable is a liability. balance sheet accounts move, the ending balance in one period is going to be the beginning balance in the next period. Income statement accounts, we will learn in the next chapter, will need to be cleared out at the end of every month so that we can start fresh. But because the balance sheet is a representation of the financial condition of the company, these counts roll over into the next period. So, okay, let's go do the next one and let's start doing some journal entries. In problem 2.2a, Denzel Brooks opens a web consulting business called Venture Consultants and completes the following transactions in the month of March. So what we have here is all these transactions for the month of March. What we need to do is take each of one of these transactions, analyze the transaction as to the effect on the accounting equation, and then determine how we're going to enter those transactions into our accounting trial balances or our T accounts so that we can get a trial balance for this problem. So let's look at the first transaction. The first transaction says on March 1st, Brooks invests $150,000 cash along with $22,000 worth of office equipment in the business in exchange for its common stock. So we look at that, and what happened? Cash went up by $150,000. Office equipment goes up by $150,000. And also we gave common stock in exchange for that investment as common stock. So what we would need to do is do a journal entry. We'd have to recognize the cash. Cash going up is a debit. So we're going to say debit cash in the amount of $150,000. And also now we're also going to recognize that office equipment went up. Well, office equipment is an asset. And so assets go up with debits. So we need to debit office equipment in the amount of $22,000. Now, in exchange for the cash and the office equipment, we gave common stock to Mr. Brooks. So we're going to, if common stock goes up and it's on the right side of our accounting equation, so common stock increases with credits. So we need to increase the common stock account. So we're going to say common stock. And we are going to do a credit entry of $172,000. So notice my debits equal my credits. And just taking a look here at the format of a journal entry, normally we record debits first and then credits second. The debit entries are on the far left-hand side. The credit entries are indented in. On the numbers, the debit entries are in one column and the credit entries are in the next column. So let's take a look at the March 2nd entry. The March 2nd entry says prepaid $6,000 in cash for 6 months worth of rent. And they give us a hint that we're going to debit prepaid insurance. Okay, prepaid rent. Prepaid rent is an asset. So when prepaid rent goes up, we're going to increase it by doing a debit entry. So we're going to increase it by $6,000. In exchange, we paid that prepaid rent with cash. So in other words, cash is going to go down by $6,000. Okay, the next entry here, we made a credit purchase of office equipment of $3,000 and office supplies of $1,200. Payment is due within 10 days. So we didn't pay any cash. We got this on credit from our vendor. So what happened is office equipment increased in the amount of $3,000. Office equipment is an asset, so assets go up with debits. We also purchased office supplies. And the office supplies are going to go up by $1,200. but we bought it with credit, so therefore we have a liability or an obligation. And so we're going to increase the liability with a credit entry for $4,200. Okay, the next entry made on the 6th. Completed services for a client and immediately received cash of $4,000. So remember the revenue recognition principle. The revenue recognition principle says we recognize revenues when we earned it. So by completing the service, we've earned the revenue of $4,000 and we received $4,000 worth of cash. So we need to increase cash. Cash goes up with a debit, so debit cash for $4,000. And we're going to increase service revenues. Now we increase service revenues because that's a revenue account. And remember, revenues increase stockholders' equity. So an increase to revenues of $4,000 is going to be a credit entry. Okay, the next entry. On the 9th, we completed a $7,500 project for the client who must pay within 30 days. So in other words, we didn't receive any cash, but the customer now owes us money. So the customer owes us money, so we're going to increase the asset called accounts receivable by the amount of the revenue we generated of $7,500 because we completed the work. And then we have to recognize the service revenue for what we earned of the $7,500. The next entry, we paid $4,200 in cash to settle the accounts payable created on March 3rd. So this entry right here where we purchased the office equipment and supplies, we're now going to pay the $4,200. If we pay the $4,200, we're no longer obligated to pay it, so we're going to decrease our obligation liability of accounts payable. We decrease liabilities with debit entries, so we're going to debit accounts payable in the amount of $4,200, and we paid that accounts payable with cash, and so we're going to decrease our cash account by $4,200. Next, on the 19th, we paid $5,000 cash for the premium on a 12-month insurance policy. Now, we're going to pay cash, so cash is going to go down by $5,000, but this 12-month insurance policy is good for 12 months, not 1 month. So we're going to get benefit for a whole year of insurance. So, in other words, we're prepaying that insurance policy. It's not insurance expense because we haven't used up that insurance policy yet. So we're going to debit or increase a resource, an asset, called prepaid insurance for the amount of the policy of $5,000. We have to credit cash because we paid cash for it. So we'll credit $5,000. Okay, the next entry is that we received $3,500 cash as a partial payment for the work completed. So we received cash, so cash goes up by $3,500. And we reduce our accounts receivable account because the customer paid us. By the $3,500. Okay, we're going to do one more and then I'll let you do the rest of these journal entries. And this last entry says we completed work for another client for $38.20. So we did the work, the client hasn't paid us yet, so we're going to debit accounts receivable again. Because for the work we've earned, $38.20, and we're going to credit, and we're going to credit services revenue by the 3820. Now I'm running out of space here, but you kind of get the idea. We need to do a debit entry and a credit entry, and notice that all our debits equal our credits at each journal entry point. Now I've left you 3 left for you to do, which is a payment of dividends, a payment of office supplies, and a payment of a utility bill to do the journal entries like we have here. But what I want to do is take you the next step. The next part of the problem says take these journal entries and post them into the ledger. Now what I have represented here is T accounts to represent the various ledger accounts, just like we did in the prior problem. So what we need to do is go for each journal entry is post the dollar amounts into the appropriate T account. So for instance, this first entry where we debit cash for $150,000, I need to go over here and put put the posting of $150,000 to represent this entry that I have here. I need to go to office equipment, and I need to post this entry of $22,000 as a debit entry because of my debit entry here. And then I have to put a credit entry of $172,000 into this entry to represent the credit that we did to common stock. We can do the same thing with the next entry, which is a debit of prepaid rent of $6,000 and a crediting of cash over here of $6,000. Notice here we have an increase to cash, a decrease to cash. The next entry, which was a debit to office equipment, we can debit office equipment by $3,000. We're going to increase office supplies by $1,200. And then we're going to recognize a liability, an increase to the liability account called accounts payable of $4,200. Next, we take the cash increase of $4,000. And we want to increase the service revenues by $4,000. The next one here, we're going to increase accounts receivable by $7,500. We're going to increase service revenues by $7,500. Next, we want to decrease, because of this payment, we want to decrease accounts payable by $4,200. We want to decrease cash over here by $4,200. The next entry here, we want to we incurred prepaid insurance. So we're going to increase prepaid insurance by $5,000. We're going to decrease cash by $5,000. Then we have our cash account here where we're going to increase it by $3,500. And we're going to decrease accounts receivable by $3,500. And then accounts receivable here goes up by $3,820. And we're going to increase our service revenues, which is over here, by the $3,820. So now I've just posted all the transactions that we've done the journals for, but let's do it for these last 3. The last 3 here, we pay $5,100 in cash for dividends. So what we should be doing is we're going to use up cash, so we're going to decrease cash by $5,100. And we're going to increase the dividend account by $5,100. The next entry here on the 30th, we purchased $600 of additional office supplies on credit. So we're going to increase the office supplies by $600. And we're going to increase accounts payable because we bought it on credit of $600. And the final entry here, we pay a $500 cash. So cash is going to go down by $500. To pay the utility bill over here, and an expense is going to increase with the debit. And we increase. So now what we have of our entries are our debit and credit entries into our ledger accounts for all the transactions that happen in the month of March. Now, when we've shown you in the lecture, what we need to do is we need to run a running balance of the various accounts so that we can create a trial balance. So what we have here is if I look at my increases in cash and my decreases in cash, I could create a little formula, and I could say, take the sum of all my increases, and I'm going to subtract out the sum of all my decreases, I have $136,700 in cash. In accounts receivable, I can do the same thing. I could take the sum of all my increases minus the sum of all my decreases, which is just one item here. And I have in accounts receivable $78.20. I could do the same thing here with office supplies. I could take the sum of my increases minus the sum of all my decreases. Well, let's try that again. The sum of all my increases minus the sum of all my decreases, which is 0, to give me 1,800. And then I'm not going to do these because there's no addition or subtraction involved here. Then also here on my office supplies, my accounts payable, notice on this side my normal balance of accounts payable is a credit, so those will be my positive numbers. And I think my last total that I need to figure out is over here, which is my service revenues. Take the sum of my service revenues minus the sum of the decreases. So I have my revenues. So now what I've done is I've posted into my ledger all the individual detailed transactions and then come up with what my totals are of balances at the end of the month. Once I take that, then I can create a trial balance. By taking the totals up here, I know like cash here is going to be $136,700. Accounts receivable is going to be $78.20. Office supplies is $1,800. Prepaid insurance, $5,000. Prepaid rent, $6,000. Office equipment, $25,000. Now, accounts payable. Notice accounts payable is a credit balance of $600. So I want to put this in the credit column of $600. My common stock is $172,000. My dividends, which is on the debit side, is $5,100. My service revenues is $153.20. And my utility expense is a $500 debit. So what I've done is I've basically taken the balances of each one of my ledger accounts and listed it in my trial balance to check whether my debits equal the credits. So let's do that. Let's check. I'm just going to add up my debit columns. And I'm going to add up my credit column. And when I compare the two, my debits equal my credits. So therefore, I know that not necessarily that I post everything to the right accounts, but that at least my debit entries equal my credit entries. From this point on, then you could create your financial statements if you had your trial balance, because now you have your assets, your liabilities, your equity, your revenues, and your expenses. So from the trial balance, while the primary purpose of the trial balance is to ensure that your debits equal your credits, the information derived from the trial balance will help you create your financial statements. So now let's go try your own homework, and hopefully this has helped you out. We'll see you in the next chapter.